So now we're going to hear from Owen Rask, the founder of Rask Australia. Super keen to hear your stock ideas. So over to you. I'm going to give you this mic.
Thanks, Candice. Thanks, Marcus. I always love it. I went to a Prezzo it's probably about 10 years ago now, mate. And I was with Alan Collar. He was there, and I saw you present, and I just loved it. It's always great to have Marcus up on the stage. For those that don't know me, does anyone listen to our podcast? Okay, a couple hands. So Marcus brought up Self-Wealth, so I'll bring it up. Every Wednesday night also, I'm the host of the Self-Wealth show, so every Wednesday night at 6 p.m, which is really cool because we get, sometimes tens of thousands of people tune in and it's heaps of fun. For the most part, I agree with a lot of what Marcus just said in that, you can just go and buy the ASX 300 ETF, Vanguard, VAS is the ticker symbol. And for a lot of our members, that's what we advocate for. We're just in the 10 across the way here, and over there we would say, get rich slow is basically what we advocate for. And one of the easiest ways to do that is through an ETF nowadays. Relatively recent invention, but it has survived through a few market crises. It's been tested in the GFC, and now the ETF structure works for a lot of people. I think, my journey, I haven't been doing this nearly as long as Marcus has, and I started investing over 10 years ago and started the business 5 years ago. And in that time, my philosophy has changed. I see a few familiar faces here. I see some members of ours here. And what's happened over that time is I was quoting all those, those banal comments from time in the market, all that sort of stuff, which I do for the most part believe in. There's actually an interesting study from Boston Consulting Group which shows that over 54% of stock market outperformance in the top 10% of stocks comes from revenue growth. So and what the study also shows, however, to Marcus's point, is that over 10 years, the business fundamentals kick in. Under 5 years, it's about sentiment. It's about that time in the market. So from where I sit, I interpreted that to mean you should probably be mindful of both. And that's, in terms of my philosophy shifting, and has shifted. I was very active early on. I worked at a company called The Motley Fool. Scott's here. It's great to see him. And then I went to a company called Zenith Investment Partners. And there what I did was, get this, I don't know, does anyone in the room know a guy called Jacob Mitchell? No? Does anyone know Hamish Douglas? Yeah, cool. Okay, so a few names that you might know. My first day, I had to interview Jacob Mitchell. My second week, I had to interview Hamish Douglas. So at the time, he was the up-and-coming fund manager. And so I was starstruck by this guy. And what I realized there was that these guys were talking about a lot of the same stuff that I was talking about. These guys were saying a lot of the same things that I'd be saying. They were doing a lot of the same things that I was doing. But as an individual investor, I realized that I'm not hamstrung by a lot of the stuff that they are. So I do have some advantages. One of those is the ability to take a very long time horizon. In the stock market, what we do is we expect long-term performance, but we measure that in the short term. So we measure companies on a quarterly basis, a 6-monthly basis, but we expect to create wealth over decades. So there's a mismatch there in terms of expectations. And as an individual investor, we do have those advantages, time horizon. One of the things that's really interesting, and I won't give the name right now because it's extremely liquid. I went to a company down in Sydney yesterday, and I spent half the day with a CEO. He's been doing it since 1994. It's just an old-style company that does manufacturing. It's listed on the ASX. He's never done an interview of over 20 minutes since he's run the company. And this company has grown its sales over 20% per year for the past 5 years. And it's still, it's done that for a very long time, paid dividends along the way as well. And speaking with him, I said to him, hey, how many fund managers do you get come through? He said, we haven't had one. I said, how many investors come through and look at the factory? He said, we get about one a year. And I was just like, okay, this is bizarre. Pays a dividend, fully franked, growing fast. They can't do anything else, but they're just tiny, so no one's heard of them. And so when I think about that, I think about the stock market as a vehicle to get exposure to people and businesses like that. To Marcus's point earlier on, the company that I'm going to talk about today, I actually don't own shares in. We don't have a recommendation for or against it. It's a company we did recommend in the past, but since we've shifted away from stock picking as the thing that we make money from, I sold my shares in this company, and that was very painful because it's gone up. So I do own ETFs. Our company owns the Vanguard 300 ETF for full disclosure. And so the company I want to talk about today is a company called Altium. And Altium trades under the ticker symbol ALU. Marcus actually pointed out a great point when he said about the Aussie dollar, US dollar. It's actually the number one risk that I see to Altium in the short term. Altium is a company that creates printed circuit boards. So when I was on the telly yesterday, I'll give you an example of what it does. So this is an iPhone, right? Inside this iPhone, if you were to rip it apart, please don't because it cost me about $2,000. Inside of this iPhone, there is a printed circuit board. The printed circuit board is the motherboard, if you like you see when you pulled apart those old desktop computers. Now this business doesn't create those. This business actually creates the software that allows designers and engineers to create that. And Altium has been around for an extremely long period of time. But since 2011, 2012, it made a shift. It used to sell this software as a perpetual license, meaning like a Microsoft Office disk. And they're a global business, but now they're shifting to subscriptions. This is a world leader in this software. It just happens to be listed here in Australia. The chairman's here in Australia. The CEO kind of flip-flops between the US and here. I think he's the only CEO in Australia that I know that has a goatee, which I don't know what that means. But the business itself, it's cashed up, pays a dividend. The trick with Altium has always been its valuation. It's the third best performing stock in Australia over the past decade. Number one is Pro Medicus, by the way, which I own, full disclosure. And then number two was Objective Corp. That's if I'm excluding all the bloody lithium miners at the moment. So Altium has performed really well. And a lot of investors have obviously clued onto that. That's why the share price went up. But it's compounding really nicely. But I want to be clear about some of the risks. The US dollar, it makes money in US dollars. So if you look at the share price recently, my intrinsic valuation 6 months ago was around about $30 to $34, right? But that's in Aussie dollars because it's on the ASX. But it earns in US dollars. So the reason that it has gone up recently, I believe, is actually from the US dollar fluctuation. So you could, if you were a value investor, you could say, well, the valuation's gone up because it earns US dollars. But as Marcus rightly pointed out, the US dollar could come way back. And in a volatile market, that can happen. So I just wanted to be mindful of that. Another thing that is really interesting with this business is it's really dependent on good trade negotiations because one of its customers is Tesla, another one is Bosch that creates the drills, I would say the best washing machine in the business, just in case you're wondering. So the company works with those types of businesses, and those businesses have globalized hugely. So you only need to flick on Bloomberg or read the AFR to know that there's something going on between China and Taiwan. Happens to be something going on there. I'll let you fill in the blanks. And so what happens is you've got manufacturing in China, but you've got design in the US or design in Europe. Now, if that breaks down, this is a business that's kind of like in the middle of all that. And so that's another key risk that you should be mindful of. The CEO has been at the business for a few decades, but he had a stint somewhere else. So if he was to leave, he's the one that's selling this vision. He uses a lot of words which are just kind of like, they just throw me. Like he says aspirational, and they use targets like way off into the future. And when they do their AGM call, it looks like it's the Russian mafia and a bunch of other dudes like standing around making all these wild calls. So I'm fully aware of that. Finally, I'll tie it off by saying that when I invest in a company like this, I am not looking to put all of my portfolio into something like this. We believe in a core and a satellite approach. One thing, if you heard our speech earlier on, we advocate for is the old taco ads, why not have both hard and soft shell? You can have a very strong low-cost core portfolio, which is what we advocate for, and then you can have your individual shares around the outside. I was chatting to Nathan Bell from The Intelligent Investor yesterday, who's a really, really nice guy and a really smart investor. And he believes, this is his opinion, that there are only 12 to 15 world-class businesses on the ASX. There are only 12 to 15 out of 2,400. They're not that easy to find. So when you find one, keep it on your watch list and be ready for it. Right? I think Altium is one of those businesses. My number's probably closer to 30 instead of 10 to 15. But I would be looking at this as an opportunity to start very small, and accumulate over time. My thesis is as follows. The business is well run. It's the number one software in the world, competing against Ansys, against Zuken, against Mental Graphics, a bunch of these other businesses. If that was to slip, you can read online forums, you can see the momentum in subscribers. If that was to slip, that's a risk. The business, as I said, is aligned. The chairman is going to probably have succession soon, so keep that in mind. The US dollar is a risk, keep that in mind. But what we're looking for is that transition to subscribers and away from perpetual licenses. That's the thesis. I said evaluation there. Valuation is just as much art, probably more than it is science. And I take a risk by telling you that. But at the end of the day, I'm looking for quality businesses, and I think this one fits the bill. So, if you have some questions, by all means.
I do. I'm happy to know that I own both of those companies, so that's a tick. That's awesome. Got a question for you, Owen. There's a lot of M&A space going on in that sector. So any thoughts and comments? Because I guess that's a catalyst, because you guys have nailed it on the head. There's a lot of short-term noise. A lot of noise investors can get caught up in the short term, but we need to stick it at the long game, right? Whether it's ETFs, managed funds, or direct. So throw it over to you, Owen, and then also M&A that you think in the bank space as well. Do you think anything's going to play out there? We've spoken a lot about the Australian market as well. Obviously, it's a conviction Aussie stock, but maybe we could wrap also on what you think, just what the heck's going on in the market. What's your perspective, and what are you telling your members?
Okay, sure, I'll go first. So Altium received a takeover offer from Autodesk not too long ago for $38.50. They knocked it back. At the time, what we're taught in, like when we do the CFA and all that sort of stuff, what we're taught is that if you're a value investor, that there's a range of expected returns. So if this, then that, right? I see Trevor in the crowd here, he knows what I'm talking about. If this, then that, right? But then we have to weight those probabilities. So we have to say it's 30% chance this happened. It's really abstract, right? But at the time, I thought that $38.50 was a great offer. I thought it was stupendous, really. I thought you can't knock this back, you got to take it. They didn't take it. And this was like peak tech stock, right? So that's one thing to be mindful of. Mental Graphics was bought out by Siemens, because Siemens tried to create this interconnected manufacturing world, which is where Altium's trying to go, but it's much smaller. The final thing that I'll say on this is that in the United States, there are 18,200 companies that have over $100 million in revenue, but they are not on the stock market. The equivalent on the stock market is 4,200. That means that there are many more private companies at scale than there are public companies. And we are seeing the best companies, not just here in Australia, but overseas, being taken out. And now that the Australian dollar is very weak, we will see more of this. And more of these good companies will be snatched out from underneath us. So that creates a whole different challenge. We obviously then lose them from our ETFs, right? So what happens? You don't have them anymore. So that's something that I'm very mindful of. And as I look at 10 years, that's the key concern with me for ETFs, but also on the active side.
That was a long question, and I don't know which bit I'm going to answer. Just something that occurred to me whilst you were talking there, Owen, is why do you invest in ETFs? Why do you think the market goes up long term? I'll tell you why the market goes up long term. Because lots of people apply their brains every day to their businesses. Staff turn up, and the whole thing is to progress, to move on. The market is always, the stock market is always going to reflect the value of businesses, the value of economies, thanks to population growth and innovation and better productivity. The market earnings are always going to grow. It's why the stock market goes up 95% of the time. And that's a great investment. And that's why Macquarie is a great investment as well. But I do think when it comes to, there are a couple of things I want to make. When it comes to, and you're not the only one to bring up a small stock with limited earnings and high volatility, is every investment is down to the individual. My demographic, which is sitting at home looking after their SMSFs, are clearly not interested in taking a lot of volatility. And if they wanted to, they would only do it with a little bit of their money on the side, probably as a bit of interest, intellect, passion, fun. But every investment has to have a volatility measure, which if you're looked at the stock market regularly, you would be able to rank, and the data we provide, you'd be able to rank every stock from volatile to unvolatile. Your personality is going to be on the scale somewhere. You've got to know where it is. If you've no idea where it is, you need to do a little bit of education about the stock market yourself and how much money you're putting into things, because a lot of the stocks I've heard that are conviction stocks are flyers, and it's going to be really hard for you to time them, and you're going to get burnt even though the idea is good if things go wrong. Whereas what you want to be doing for most investors, if you're looking long term, is take the volatility out of it, and that's why everyone's gone ETFs. Because if you've got an ETF over 300 stocks, it is always less volatile than every other individual stock in that index. So that's why you would go ETFs. So just be careful with your stock picking. Wealth does not await you. The stock market is here to look after money you've made, not to make you money, okay? All the people here who are in their prime earning years for career business building, get on with that, because that's where you go. I have had thousands, no, I haven't had thousands, I've had hundreds of clients over my broking career, and the ones that are particularly wealthy are always the ones that built a business. How do you build a business? You don't earn an income, you build an asset whilst you're earning an income, all right? That's the game. There are far more important things for you to be doing than pissing around in individual stocks in the stock market. You should be getting on with your careers, your businesses, building assets, and that is the most important message I could pass on to a younger demographic. This is a fun bit, picking stocks, listening to conviction picks. This is fun. It's not wealth, right? That's something altogether different. You need to build your own wealth, and you're not going to do it in the stock market.
Well, thank you both to Marcus and Owen. That was a great session. If you'd like to ask the guys any burning question you do have, they will be available just over there behind this wall.
Equity mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.